It is 1933. The Dow has collapsed 89%. Nearly 10,000 banks have failed. 25% of Americans out of work. And yet, right in the middle of the worst financial crisis in American history, ordinary families, not the ultra-rich, not Wall Street insiders, were quietly building generational wealth. How? 3 assets. And what's terrifying is that those same assets are sitting in front of you right now. Welcome back to Elite Grind Group. I'm Marco Valenti. Today we are going into the history books because financial history doesn't repeat itself exactly, but it rhymes. And right now in 2026, the rhyme is getting loud. Tariffs, bank stress, consumer debt at record highs, recession odds climbing. The same macro pattern that unfolded in 1929 is showing up in the data today. So instead of guessing what's coming, we're going to study what worked and give you the blueprint that history has already proven. Stay with me, because asset number 3 is the one that almost nobody talks about, and it may be the most powerful of all. Let's start with asset number 1, gold mining stocks. Now, when the stock market crashed in 1929, most people panicked and sold everything. The Dow Jones Industrial Average lost 89% of its value by 1932. But here's what the financial history books buried. While the Dow was being destroyed, Homestake Mining, the largest gold producer in the United States, went up 474%. That's not a typo. 474%. $1,000 invested in Homestake in December of 1928 grew to $6,760 by 1938. But it gets better. Homestake didn't just grow in price, it paid dividends every single year, while banks were handing depositors 1% interest or collapsing entirely. Homestake's dividend went from $7 per share all the way up to $56 per share by 1935. Canada's Dome mines went up 558% in the same period. Why? Because during an economic collapse, when paper currency loses trust, when banks are failing, people rush to gold. And gold mining companies don't just hold gold, they produce it, with costs that drop during deflation, which means profit margins explode. The families who understood this in 1933 didn't just survive, they thrived. Now, fast forward to 2026. Gold has been hitting all-time highs, and gold mining stocks are still flying under the radar for most retail investors. Sound familiar? Asset number 2, and this one is going to shock you. Distressed real estate. Here's the history that nobody teaches in school. Between 1929 and 1933, residential construction in the United States collapsed by 95%. Housing prices dropped 35% overnight. In 1933 alone, over 1,000 families were losing their homes to foreclosure every single day. For the masses, this was catastrophic. But for families with cash, or even just a small amount of liquidity, it was the greatest buying opportunity of the 20th century. Joseph Kennedy, yes, the Kennedy family, bought real estate rights for pennies on the dollar during this period. Fred Trump, Donald Trump's father, used cash from grocery store sales to buy depressed properties in Queens that formed the foundation of the Trump real estate empire. These weren't billionaires. They were ordinary business people who had one thing the panicked masses didn't. They understood that when everyone is selling, the smart money is buying. Here's the modern lesson. Right now, in 2026, commercial real estate is under historic stress. Office vacancy rates at record highs. Distressed property listings climbing. Interest rate pressure squeezing over-leveraged owners. The 1933 Playbook is available right now if you know where to look. Asset number 3, and this is the one that blew my mind when I dug into the research. Essential consumer businesses, specifically grocery and low-cost entertainment. Here's what the data shows. In 1932, there were just 300 supermarkets in America. By 1939, 4,500. In the middle of the worst economic collapse in history, the grocery industry exploded. Because here's the economic reality nobody talks about. People stop buying luxury, they never stop buying food. Michael Cullen launched King Cullen, America's first real supermarket, in 1930, right in the pit of the Depression, and was generating over $6 million in sales, which is more than $100 million in today's money, before he even died in 1936. George Jenkins opened the first Publix in 1930. That company is now worth $40 billion. Hollywood, another essential escape, didn't collapse during the Depression. It boomed. Mae West earned $300,000 per film role during the 1930s, making her the highest-paid woman in America. The pattern is undeniable. Assets tied to essential human needs, food, shelter, low-cost entertainment, don't just survive economic collapse, they accelerate through it. In 2026, this means consumer staples, discount retail, and essential services are not boring investments. They are the fortress investments, the ones with 90 years of historical data behind them. So let's bring this home. 1933, the worst financial crisis in American history. Most people, paralyzed by fear, lost everything. But the families who studied history, who understood that every collapse creates opportunity, they came out the other side with wealth that lasted generations. 3 assets. Gold mining stocks. That returned nearly 500% while the Dow died. Distressed real estate. Bought for pennies when the panicked masses were selling. And essential consumer businesses that thrived because human beings still needed to eat, still needed shelter, still needed something to believe in. The question for you in 2026 is simple. Are you studying the history or are you going to repeat it? If this video gave you value, hit that subscribe button, drop a comment below. Tell me which asset surprised you the most. And if you want the full 2026 Wealth Protection Playbook, the next video is already queued up. Don't sleep on it. The content presented in this video is for educational and entertainment purposes only. It is not intended as financial, investment, or legal advice. Elite Grind Group and Marco Valenti are not licensed financial advisors. All historical data referenced is sourced from public financial records. Always conduct your own research and consult a qualified financial professional before making any investment decisions. Past performance of any asset class does not guarantee future results. Stay focused, stay consistent, stay elite.